Hello, good morning, good afternoon, wherever it is you may be watching this. Welcome to the very first episode of Learning to Play. This is going to be a series where we're going to dive into a whole heap of macroeconomics. We want to get a thorough understanding of what drives different prices, both in stock markets, in commodities, and in currencies, to get a real big grasp on firm understanding on how these things move and then build an edge so we can get ourselves on the right side of the market when this data does get released at a later date. Today, we're going to be diving into GDP, right? If you already know what GDP is, that's fantastic. I do recommend you still give this video a watch, not only to refresh your mind, but also to get an understanding of how I like to use GDP to make trading decisions when we get different data announcements and comparing different economies. So I'm not going to waste too much time. Let's get into it. If you're excited for this series, hit the like button so we know, so we can keep creating more and more. And let's move in, shall we? The first thing we need to ask ourselves is, what is GDP? Okay, what actually is GDP? When we're talking about it, when people are on about it, and it's breaking the headlines, it's moving assets. You can see it on maybe the Forex Factory calendar, but you're just not sure on what it is or what it does. Well, GDP is gross domestic product, okay? And what that is, it's a measure of the economic activity of a country. Very simply, it's a complete measure on how that country is doing economically, okay? It's a monetary value of all the goods and services produced within a country's borders during a specific period of time. Typically, this sits around about a year, okay? So they'll measure it for a year, and that's the data you'll go off. GDP is one of the most commonly used indicators out there of a country's economic health, okay? It is used to compare the economic performance of different countries, and we're going to dive into that a little bit more. We can use this as an incentive on why a currency should do better against another, or why a certain country's stock market is looking more bullish than others. How do we calculate the GDP? There's several ways to calculate GDP, but the most common method, and the method we're going to talk through today, is the expenditure approach. Okay? Expenditure approach adds up the total spending of goods and services within a country's borders. This method can be broken down into 4 key components. The first component is personal consumption, which I'm going to mark here with an orange C. Okay, personal consumption is the measure of the value of all the goods and services purchased by households. Okay, so families, you and I, not businesses, individuals. How much are we spending on goods and services? Then we have gross private domestic investment. This measures the value of all investments made by businesses. This includes purchasing of new factories, equipment, inventory, you name it, a business expense will come under the private domestic investment. Our next core component is government consumption and investment. This measures the value of all goods and services purchased by the government, as well as any investments made by the government. And then finally, we have net exports, which is pretty self-explanatory, but this measures the value of a country's exports minus the value of its imports, okay? These are the 4 key components we use when developing our GDP figures, right? And understanding using the expenditure approach. Now, the formula is very simple. It's C plus I plus G plus NX equals GDP. That's personal consumption plus gross private domestic investment plus government consumption and investment plus net exports, which is NX, and that equals GDP. It's very important to note that GDP figures are based on estimates and subject to revision as more information becomes available. GDP is often revised a number of times, okay, after the original number is produced. Okay, it's revised a number of times to take into account new data, so it's not uncommon for GDP figures to be changed later in both an upward or downward direction once that release comes out. Now we've got a firm understanding on how we calculate it and what it is. Why do we care? Why do we care about GDP? Why do we care that this is a figure and we can measure everything that's going on. And it's quite simple, actually. GDP is often used as a measure of a country's standard of living. Okay, so GDP can equal a country's standard of living. Very simple, right? As a higher GDP per capita, which is GDP divided by the population, generally indicates a higher standard of living. If we have a higher standard of living, it usually measures economic growth, right? It's giving you incentive that, okay, the standard of living is on the upward trend, which means the economy as a whole is on an upward trend. Now, if the standard of living was depleting, well, then obviously the economic would be shrinking, or the economic trends would be shrinking. Right, so it can give us a bit of incentive. Now, why do we care if the economy is growing or shrinking? Well, the economic growth or the economic shrinking directly moves prices and value in currencies. So if we can find an economy that has strong growth and it's setting some strong trends to the point in the near future, it's going to continue that way. And we can find another country that's not doing as well and the strength and the trends are showing that it's going to continue that way. We can pair those together like we do when we trade FX, and we can find a very definitive bias on which way we want that to go. Okay. It's very, very simple in the way that GDP can indicate how economy is growing or shrinking, and then we can make trading biases based off that. Going further into detail on how do we trade GDP. Okay. Now, there's a couple of different methods you can do that, but the main one is comparison to other currencies, like I've just spoke about. Okay, we can compare the GDP growth rate with other countries. That's very simple. The GDP growth rate, how fast are we growing? How slow are we growing? Are we shrinking? Comparing a country's GDP growth rate to that of another country, as I previously just described, can provide insights into how its economy is performing relative to others. A higher GDP growth rate generally indicates a stronger economy and therefore a stronger currency. So once again, if you can find a country that has a really strong GDP growth rate and their economy is growing and pair it against a country that doesn't look too hot, well, then you can find that middle ground there and maybe find some opportunities in trading that exchange rate. You can also compare GDP per capita. Now, GDP per capita, which is GDP divided by the population, can provide a measure of a country's standard of living. And this goes back into how you compare it with growth rate. It's just a bit of a different figure. A higher GDP per capita indicates higher standard of living, which can then indicate a higher sign of stronger economy, and therefore stronger economy can equal a stronger currency. Very simple. It is very important to note with GDP and to remember that it's just one measure of a country's economy. And that other measures such as unemployment, income equality, environmental impact, all of these things should be considered together to have a complete comprehensive understanding of a country's economic health. So let's not just use GDP by itself and only GDP or base any decisions off of that. It is something that we need to use in comparison with some of the other things we're going to talk about in a future episode. It's a very quick little run through. It's very easy to understand. I hope it broke it down and taught you a little bit about GDP and maybe piqued your interest into looking into more macroeconomics when it does come down to trading currencies and in stocks. If you did enjoy this little video, please leave a like, leave a comment if you have any questions, and we'll see you next time on Learning to Play. Thanks.